market at record highs, does it deserve to be there?
Yeah, it probably does deserve to be there. It's just difficult to make a case strongly that we should go a lot higher in the near term. We think the markets can probably go as high as earnings growth will propel it. So we know this quarter we're probably going to finish, we're tracking right now about 2.5% to the positive on earnings growth. But for the full year, you're talking about somewhere around 3 to 4% earnings growth. Next year is still projected, if you believe consensus, at about 12, 13% earnings growth, which to us looks too high. We think that number's got to come down. We think it's more like about a 6 to 7% number, Dom.
All right, so valuations have certainly been going higher, but they are not anywhere near bubblicious type territory. What exactly does get investors and traders to pay more in stock price for every dollar of earnings a company generates? What gets that multiple expansion?
Well, you're spot on right. What's interesting is if you break down the numbers this year between where have those 21% S&P returns come from, earnings growth, multiple expansion, or dividends, over 90% of this year's returns have come from from multiple expansion. That's not the healthy way to get your returns. You want to get it through earnings growth. So again, to pay up, we've got to see more earnings growth. Now, what's interesting is when you go a layer down into the sectors, there's only 3 sectors now that are beating the S&P 500 this year, meaning that they're carrying all the water and the weight. It's tech, it's consumer discretionary, and industrials. The other 8 sectors are all underperforming the broad indice today. So investors are being much more selective about where they get their growth. And as we saw with the headlines with technology, it's kind of like Teflon tech. Nothing seems to affect tech these days, even when it has bad headlines or even some shaky earnings numbers.
Darrell, the bulls would say that that's where you want to see the leadership, in cyclical, economically sensitive sectors like technology, like industrials, like consumer discretionary. So isn't that a good thing, or are things getting a little bit stretched because of those valuations and runs in cyclical sectors?
No, I think at this point in the cycle, to us, you still want to pay up in the cyclical sector if you're going to pay up anywhere, because that's where you can still drive top line growth. So as input costs go up, as wage costs go up, as more pressure comes on margins, what you want are sector exposures that are going to be able to drive that sales and top line growth. We think that's still cyclicals over defensives. We've been saying that all year. In fact, cyclicals have outperformed defensive by almost 800 basis points this year. That trend looks intact and would be consistent with kind of late cycle or mid to late cycle stages of an economic recovery.
Mid to late cycle doesn't sound good. So what are the biggest risks out there? I mean, we've seen the bulls play out. What exactly should markets and traders be watchful for on the downside?
So I would say 2 things that we think are most important. Number one, we just got done talking about, you've got to see a resurgence in earnings growth. 3 to 4% earnings growth this year, and if we get that again in 2020, is not going to allow multiples to expand or people to pay up in this type of environment. Probably the other thing that most concerns us is what the market, in particular the bond market, is pricing in for interest rate hikes over the next 12 months. Right now, if you believe Fed funds futures, they would tell you the Fed is going to lower rates by 100 basis points in the next 12 months. That seems too aggressive to us. So there's a risk that that could disappoint markets if they, in fact, don't follow through with 4 rate cuts or 100 basis points of rate cuts.